Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Traders watching if the greenback can sustain its momentum this year after its strongest yearly advance in nearly a decade. Juckes of SocGen writes, given the recent economic and political trends, dollar bears should hibernate over the winter. Spring shoots of life in the European economy, signs of fatigue in this incredible US cycle, and clarity on the policies of President Trump may all help by summertime. Patience is required through the winter and spring. Kit joins us now to kick off 25 in the FX market. Kit, Happy New Year and welcome to the programme, sir. Let's start with US exceptionalism. What is it built on and how sustainable are those pillars?
Some of it's sustainable. I mean, the technological gains, you've just been talking about them, they're a huge part of it. If we believe in the AI revolution and we believe in Mag 7 and everything that's happening, then you know, the US has cornered that. So let's not knock that. I wouldn't necessarily knock the fact that the US has run a significantly more accommodative fiscal policy since 2020, really. You know, everybody in Europe's been struggling to try to get their budget balances back under control. The US has kept them accommodative policy and has had more growth, and that helps keep the deficit a little bit more under control than elsewhere. So there's more than one piece to this that's been there. But if the US does have to tighten fiscal policy, at some point, that may slow things down. We'll see how big the AI revolution really is in the next 10 years or so. I am not clever enough to judge quite how much continued growth that can give. And we'll see whether the US can cope with the demands on the labor force, because the economy is running at this point on wealth gains from asset price increases, a tight labor market, a fairly divided economy in terms of winners and losers. And it doesn't look to me as if it's got much potential to accelerate in growth or indeed to continue at recent growth rates for that long unless we can get a productivity miracle from somewhere.
Kit, what do you think is going to drive further dollar strength if we get it, or perhaps euro strength? Will it be European disappointments, European surprises to the upside? Will it be rate differentials, or will it be ultimately just a real question of what the neutral rate is in the United States?
I think the neutral rate is higher in the United States than in Europe, and you know, that's a challenge that doesn't get written up about enough. Just that if my neutral rate's higher than your neutral rate, my currency ought to be going up forever. I mean, it's not a stable equilibrium if we have these big divergences in neutral policy rates. So that's a major factor, but I think it's largely in the price. What I'm most uncertain about is the politics, in the sense of, have we priced in too much of what people expect from President-elect Trump, or have we not priced it all in at all yet in terms of what that does for the dollar? I've read so many pieces talking about the possible negative growth effects of his tariff proposals, plans, threats, whatever we want to call them. If he wants to get a deal that's good for the US, it has to be a deal that's good for the world and good for global trade. And if he does that, there's more upside to growth elsewhere than there is in the US from those deals, if only everybody can embrace them. And that wouldn't be good for the dollar. So at the margin, I think the politics will be more important than the kind of straight economics. If all we're doing is trading what's happening economically now, I think we're just going to have a very strong dollar for as far as the eye can see. The debate about whether it can get back to parity for Eurodollar or you know, a little bit stronger generally than it is now, it's a tough debate. It's a really expensive currency that will stay expensive as long as the rest of the world is shoveling all of its savings into the United States to see how much money it can make out of the U.S. equity market.
Just quickly, is the spike that we've seen in natural gas prices in Europe just noise, or is that something you're watching that could potentially affect the pair?
Oh, I think we have to watch it pretty closely. I mean, it's, you know, we've known this was coming for long enough that you'd have thought some of it would be in the price, but with raw materials, nothing ever is, right? You know, if the pipes close down and it suddenly gets really cold, then you can have a short-term spike that can have a short-term impact on growth, that can have a short-term impact on the currency that's pretty negative. That the way we got eurodollar to 95 back in 2022 was a terms of trade shock caused by higher gas prices. So we shouldn't ignore it completely.
Hey Kit, good to see you. As always, Kit Juckes there, SocGen. Let's turn back to tech. Ives of Wedbush writing, we expect tech stocks to be up 25% in 2025 as the street further digests a less regulatory spider web under Trump in the White House, with current FTC days in the rearview mirror. Stronger AI initiatives on the way, and a Goldilocks foundation for big tech and Tesla looking into 25 and beyond. Dan Ives joins us now for more. Dan, good morning.
Great to be here.
Happy New Year, sir. It's good to see you. We can talk about some of these big gains through 24. Palantir up 340%, Nvidia up 171, Tesla up 62. Here's another one. Vistra up by 258%. That was the biggest winner on the S&P 500 last year. That's a utility company.
Yep.
What does that tell you about the state of play in AI?
It's about second, third derivatives of AI. I mean, I think the big thing is it's $2 trillion of AI CapEx next 3 years. And I think, look, that's numbers that are really, I believe, going to be in stone. And there's a multiplier. For every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across software and across the rest of tech and infrastructure. You think about the power, the utilities, nuclear energy, names like ACO and others. I mean, it just speaks to we're going into a new age. It's not just about big tech. I mean, to your point about small caps, I think the big sort of prove-it moment is the multiplier playing out. It's the rest of tech, the rest of utilities, the rest of the market participating in this AI trend. That's really, if you think about that party, the only ones let in behind the velvet ropes have been that Mag 7.
Nvidia has been selling the picks and shovels. They've made a fortune. We've seen all the growth. Does Microsoft and Google and the like that have been spending all that money need to show some gold this year in a big way?
Yeah, and I think that'll start this quarter. I think you're going to see an inflection point in the hyperscalers for Microsoft, for Amazon, for Google, in terms of what we see with more and more of those cloud workloads now showing up. And I think it's all about use cases. That's why you look at the Messi of AI, Palantir, in terms of what they've done, that's just the first piece. Salesforce has been another. Software now starts to actually participate in this AI revolution. That's going to be a key theme across 2025. Remember, with Con done at the FTC, M&A is going to massively accelerate, and that's another theme we're going to be seeing across tech.
What we saw at the end of last year was a lot of these other companies, sort of the side effects of AI or the actual applications. We saw them take a pause in the applications of AI and really study exactly the use cases, study the most efficient way to do it. They stopped deploying as much cash. What makes you think that they can apply some of the AI technology quickly enough to keep delivering the kinds of expansion and gains in the hyperscalers to keep a 20-25% return that you're expecting in 2025?
Yeah, it's a great point. Look, that's all the work we do. I mean, we look at, when we talk to enterprise around the world and all the travel we do in Asia, it's showing that these use cases, they're exploding for the enterprise. So as the ROI starts to continue to increase, that's why you're starting to see, you saw Palantir starting in Salesforce, you're going to see Mongo, Snowflake, and others. You're going to see it spread across the board on enterprise. But again, like the ship's left the port. In other words, the AI CapEx is going to be there. Now 2025 is going to be about showing it, proving it in numbers. And that's why the reason we think tech stocks are going to be up 25%, it's not just about big tech. It's about the rest of tech participating, software, infrastructure. And look, I always say, like, haters hate. The last few years, that's sort of been, what we've seen in tech. They will continue to sort of fire in a crowd theater type situations, but I think tech continues to move higher.
How predicated is this theory on the idea that there can be some sort of expansion of the H-1B visas, that there can be an ongoing increase in employees and top talent to the United States?
For the first time in 30 years, the U.S. is ahead of China. I mean, in my perspective, from when it comes to tech. But to fuel that in terms of AI revolution, it's talent. And I think what we've definitely seen a lack, I would say supply, demand. These companies more and more need to continue to fuel this with talent. So when you look at what we're seeing with H-1B and ultimately as that all plays out, it will be something very, very important that plays out in Silicon Valley and across the tech world in 2025.
Elon Musk has been at the forefront of this debate, this argument over the holiday period. Let's talk about Tesla. Tesla an outlier in a pretty dreadful auto market, particularly for the European players. I think it was Stan Druckenmiller that once said, you'd be surprised by how few people understand what makes a stock go up or down.
Sure.
What makes Tesla go up or down? Because it sure as hell doesn't seem to be car sales. It has to be something much bigger than that.
And we're going to have deliveries probably in the next few hours, right, in terms of Q4. Look, I think this is an autonomous AI story for the next few years. And it goes back to the bet for the ages that Musk made on Trump continue. I think is going to really play out as the autonomous future. That's what you're betting on in Tesla. You don't see that in numbers today, but I think ultimately, I think that's worth $1 trillion alone in terms of the AI autonomous story. But next few hours, this week, we'll be talking about deliveries. And it comes down to China deliveries, which were really a disaster at points in the last, call it 12 to 18 months, have now started to rebound for Tesla, and that's going to be very important.
What gives you the confidence that that will continue? Because there are some similar questions happening in the luxury space with companies like LVMH. Is China actually bottoming out for the consumer side of things? What gives you that confidence for 25?
It's what we see in terms of demand, in terms of what we see in terms of the overall China market for EVs. I think Tesla, I think a lot of those price cuts in the rearview mirror, we're going to have white knuckle moments. But ultimately, I think China is something that could be up 20% when it comes to delivery for Tesla. And that's why I think right now it's one where I think where the bears have sort of misunderstood Tesla, it's 10 to 15% of delivery story now. It's 85, 90% AI autonomous in terms of the future for Musk and Tesla.
Sort of when you put together some of the things that you're talking about, you think for the first time in 30 years, the U.S. is actually ahead of China when it comes to development. At the same time, Tesla's dominance and success has hinged on its success in China. So how do you see the evolution in 2025 of the increasing divide, the increasing isolation between China's sort of tech stack and the United States' tech stack, and how those sort of both compete but also evolve in parallel?
Yeah, and it's a game of high-stakes poker, because the reality is that the reason Jensen's godfather of AI and what we've seen with NVIDIA, where the chips coming from China, coming from Asia. So that's why we're going to see this all play out with the China tariff discussions. I believe Musk is going to be heavily involved there. Cook, 10% politician, 90% CEO. Apple also plays a key role here. But I just believe that's something that ultimately it's not going to spoil the AI revolution trade. It's not going to spoil the chip trade. We will go through white knuckle moments, but my view, and it's been the playbook the last few years, you buy the winners on those opportunities. And I think that's going to be the theme this year.
Pick the winner of the year. Your number one stock pick for 25. What is it?
I think, to me, number one stock pick, I think continues to be NVIDIA here. And the reason it is that there's only one game in town when it comes to AI. It's the godfather of AI, Jensen NVIDIA. Stocks obviously sold off. I think we sit here, them along with Apple will be the first ones in that exclusive $4 trillion market cap club.
Wow. The stock is up again this morning by 1.6%. Dan, Happy New Year.
Happy New Year.
Good to see you, buddy. Thanks for being here. Dan Ives there of Wedbush. Earl Davis of BMO joins us now for more. Earl, with yields lower on the session by 5 basis points at 451. First of all, sir, Happy New Year and welcome to the program. There's a lot to consider for the next 12 months, and there was 3 points that you put down. Tariffs, increased bond supply, and a Powell showdown. Earl, of the conversations you've had with your clients, out of those three, what did you spend most time on?
Well, we definitely spend the most time on tariffs right now, but it's a big unknown. And we actually tell people tariffs right now is providing us with an opportunity to go longer fixed income. And the reason why that is all the talk about tariffs and the unknowns have increased yields to these levels, to what we would deem relatively attractive levels, both on a treasury and a corporate space. So we've been using this as an opportunity to add to duration and add to credit.
So, let's start with treasury and then we can move to credit. Is there a specific place on the treasury curve where you feel more comfortable doing that?
Yeah, we actually feel 10 years you're adequately rewarded at around 4.5. This first quarter is going to be very telling for treasuries. And the reason why it is typically in the first quarter, what you get is real money accounts. And I'm talking about not hedge funds. I'm talking about large insurance funds, large pension plans. Typically, real money accounts in the first quarter reallocate their risk between, fixed income and riskier assets. Given the price action that we saw last year, we should be seeing a significant rotation into fixed income this first quarter. It's an unknown because of the inflation and tariffs as to whether that would happen, but we're putting our chips on the square that it will. So what that means is from these levels at 4.5 in 10-year yields, there's a better chance of seeing 4.25 than 4.75 in the first quarter of 2025.
Earl, how much is this driven by international accounts? We've been talking all morning about the euro and about the divergence between rates and real rates in the U.S. versus Europe. How much is that the real money that you expect to come back in and say on a relative basis, I'd rather put my money in treasuries?
The interesting thing is in the analysis I just gave you into the first quarter, I didn't even take into account international. Now you add in international, which does have an increasing appetite for U.S. assets. That bodes well for all U.S. assets, including fixed income. So that's another argument why we believe, at least in the first quarter, it will be higher for longer, but we think there's a better chance of seeing 4.25 and 4.75. I'll add in one more reason as to why we're overweight duration in 10-year U.S. treasuries and tips at these levels is that we expect tax receipts to be pretty good, which means the refunding announcement or the amount of treasuries to be issued in the first quarter and first half of this year could surprise to the downside.
Normally when you have a rally in treasuries, it's negative when it comes to risk assets. This time, though, you actually see it being positive for credit. And I'm curious about why, given the fact that typically when people pile into treasuries, it's a sign that the economy is slowing.
Well, you have to break down treasuries into two things. One is inflation and inflation expectation, and the other one is real rates. Those are the two drivers of treasury yields. Why we think this could be good for both risk assets and fixed income, the reason why we rally to 425, where we see that, we believe 10-year tips, which is the real rate, which is approximately 220 now, could easily go down to 2% and 190. And the reason why we say easily is if you're an international investor looking to invest in the U.S. and you could get 220 basis points over inflation for the balance of your holdings, 10-year tips, that's where you go. So we think the tip rally is going to be the driver of lower yields, which is also beneficial for risk assets because it reduces your discount rate on your cash flows.
Oh, can we just sit on credit just for a beat longer? In equities, we spent a lot of time over the last month talking about negative breadth, the underperformance we'd seen beneath the surface of the market, what we're seeing on the small caps, terrible month in December after a great November. Did you see any confirmation of weakness in high yield at all? Any reason for concern?
I wouldn't say confirmation of weakness. We have seen high yield spreads widen, and that just came off of let's call it profit taking in December. But we do believe the environment, the context in which the economy is set up for in 2025 under Trump presidency is beneficial for small, medium, and larger size companies, the deregulation. So what that means for us is a lower chance of probability of default in 2025. When we see lower chance of probability of default in 2025, that makes high yield more attractive because we say we're getting, even though it's tight credit spreads, we're still getting rewarded, especially on an all-in yield, for the risk that we're taking. So we're actually looking for opportunities to increase our high yield exposure selectively with selective names as an active manager does.
Earl, good to see you. As always, Happy New Year. Earl Davis there of BMO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.